Welcome back to The Deep Dive, where we take your complex stack of sources and distill the most crucial insights. Today, we are really getting into the fusion of two massive high-stakes markets, the high-leverage world of derivatives and the transparent infrastructure of decentralized finance. Our subject is Avantis, or AVNT. It's a protocol that lets you trade global macro assets, think the Japanese yen, with, well, extraordinary leverage directly from your crypto wallet.
And that's really the core of it today. We're looking at Avantis because it's become the largest derivatives exchange on the Base network. And that's a critical detail, given Base is incubated by Coinbase. But what's truly remarkable, I think, is how Avantis didn't just build a better mousetrap for crypto trading. They immediately pivoted to real-world assets, or RWAs. That move makes them the largest decentralized exchange focused on macro trading, period.
And you, the listener, need to understand the sheer scale we're talking about here. The sources confirm this isn't some theoretical project. It has already processed over $18 billion in cumulative trading volume. We're talking about infrastructure that lets traders access up to 500x leverage on some currency pairs. That level of scale and, frankly, that risk profile is what makes this deep dive so essential. Our mission is to understand the tech that enables this and the huge regulatory cloud, specifically the Clarity Act, that frames its future in the U.S.
Okay, let's unpack this.
Please do. How does Avantis even achieve that scale? 500x leverage on a decentralized chain like Base and Ethereum Layer 2. We're used to DeFi exchanges needing these huge scattered tools of liquidity. What is the core innovation here?
It's all built on what they call the universal leverage layer. The breakthrough is abstracting away the classic order book. They completely bypass that need to match a specific buyer with a specific seller for every asset. Instead, it's a peer-to-pool model. Meaning there is one single massive liquidity treasury. It's all backed by USDC. And that one pool acts as the counterparty for all trades. Doesn't matter if you're trading Bitcoin, gold, or the euro. This synthetic approach creates a kind of capital efficiency that's just very tough to beat.
That capital efficiency is the headline, sure, but what's the hidden trade-off? If you don't have an order book, where does price discovery suffer? Or where do you introduce systemic risk?
Well, that's where their risk modeling gets really complex. But for pure efficiency, the synthetic model lets them offer deep, instant liquidity across, I think it's over 80 markets now, including 22 RWA assets. And they do it without the headache of liquidity being fragmented across separate pools for every single pair.
And to really sharpen that user experience, Avantis introduced the zero-fee perpetual, the ZFP. This feels like a huge draw for high-frequency traders.
Oh, it's a genuinely clever innovation. It completely flips the traditional exchange economic model. With ZFP, high-frequency traders, scalpers, people trading in and out hundreds of times a day, they pay zero opening, zero closing, and zero borrowing fees upfront.
So how does the protocol make any money then?
The fee is only charged if the trader closes a winning position. So this model, it kind of flips the economic risk onto the protocol, but only for successful trades. It creates this self-selecting mechanism for profitable volume, and it minimizes the revenue loss from unprofitable accounts. Right now, this ZFP product is available for the big ones, BTC, SOL, and ETH, with up to 250x leverage.
That's a bold financial model. But in a peer-to-pool system, the LPs, the people providing that USDC, they're basically taking on the risk of the entire vault. How does Avantis keep the traders and the LPs' interests aligned, especially when that vault is constantly exposed?
That alignment is, it's paramount for the long-term health of the system. They use two key balancing mechanisms. First, you have loss rebates. So if you, the trader, open a position that goes against the current long-short skew of the platform, so you're helping balance the vault's risk, you can get up to a 20% loss rebate if that trade goes south.
So they're financially incentivizing traders to act as arbitrageurs for the protocol's own internal risk. That's smart.
Exactly. It uses the market itself to stabilize its risk exposure. And the second mechanism is positive slippage. If your order actually reduces the overall risk of the vault, say closing a huge long position when the vault is already heavily long, Avantis rewards you with execution at a better than market price. You get paid for de-risking the system.
That sounds like a highly sophisticated risk balancing system, but let's be blunt, 500x leverage is just astronomical. If I opened a massive leverage long on your USD and the trade moved just 0.2%, wouldn't that single event potentially wipe out a huge chunk of the protocol's liquidity? How is that systemic risk actually managed?
You're right to be skeptical, and this is where the complexity is absolutely necessary. It's managed through multi-layered risk architecture. It starts with their dual vault AMM system. Liquidity providers don't just throw funds into one big pool. They actively choose their risk exposure. They deposit into either the senior tranche or the junior tranche.
Wait, run that by me again.
Yeah.
How are those two tranches fundamentally different?
Think of it like senior and junior debt in TradFi. The senior tranche is the lower risk option. It's protected by the junior tranche. It only takes about 35% of the overall profits and losses. The junior tranche is the first line of defense. It absorbs a greater share of losses first, but in exchange, LPs in that tranche earn the lion's share, around 65% of the profits.
So the junior tranche is the cushion. It takes on that disproportionate risk for a shot at much higher rewards.
Precisely, and LPs are also encouraged to set time lock parameters, say 30 or 90 days. It's similar to concentrated liquidity, but applied to their risk commitment. That provides a guaranteed pool of long-term capital stability.
Okay, that handles internal risk separation. But what about external risk? I'm thinking specifically about Oracle manipulation. In a model like this, if your price feed is wrong, the entire vault could be drained instantly.
Yeah, reliability is everything, which is why they use a robust dual Oracle system. The primary feed for low latency prices is the PIF network. It's fast, which you need for HFT, but they use Chainlink as a decentralized fallback, and specifically to verify price bounds.
What does that look like in practice?
It's a safety valve. If the price from PIF deviates by more than 5% from the Chainlink feed, which is slower but super decentralized, all orders are just automatically canceled. It ensures you can't execute trades against a faulty price, protecting everyone.
And to make sure those executions feel fast, like a centralized exchange, I saw they were early integrators of Base's Flash Blocks tech.
That integration is absolutely crucial. It's all about matching that CEX user experience. Low latency on-chain means the lag between you hitting buy and the trade confirming is like milliseconds. The goal is to match the speed of a Binance or a Coinbase, but with all the transparency and self-custody of being on-chain.
So we've established this complex security structure, but why go to all that trouble? Why build this whole thing just for crypto pairs? And that brings us to Avantis' core thesis, real-world assets.
That is the real differentiator. Avantis has a clear mission to provide trading opportunities based on exogenous factors, global macro events, right alongside the endogenous crypto trades. Their core thesis is explicit in the documents. RWAs are the next wave that will hum in 100x on-chain trading. They're building plumbing that's robust enough to handle the sheer volume of traditional markets.
And here's where it gets really interesting, because they are effectively importing huge traditional financial markets onto a layer 2 blockchain. We're talking up to 500x leverage on 4x pairs, the largest market in the world, like the yen or USD.
And that extreme leverage is actually necessary for these assets. Unlike crypto, fiat currency pairs have pretty low volatility, so traders must have high leverage to generate meaningful returns. This is democratizing access to institutional-level FX trading.
And it goes beyond currency. They also allow trading on major commodities, gold, silver, crude oil, all directly from a crypto wallet. You cut out the traditional brokerage middleman.
And their ambitions went even further last year. In September 2025, they launched perpetuals for tokenized equities, specifically the Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Google, Tesla, and Meta. This move is a direct challenge to existing TradFi platforms by offering really competitive borrowing fees using decentralized collateral.
This rapid scaling into less liquid, more complex assets is a huge feat.
It is, and it's only possible because their synthetic model and those risk tranches let them onboard these assets way faster than competitors like GMX. They're also smart about ecosystem integration. They're leveraging protocols like Morpho, which lets users borrow USDC against their BTC or ETH to use as collateral on Avantis.
Okay, we've talked tech, we've talked money, but now we have to talk about the massive regulatory elephant in the room. The ability of Avantis to offer these assets globally depends heavily on regulatory clarity, which the US has famously lacked. It's been years of regulation by enforcement between the SEC and the CFTC.
That jurisdictional ambiguity is the exact target of the Digital Asset Market Clarity Act of 2025. The Clarity Act, HR 3633. This is the industry's major legislative attempt to finally solve that turf war by defining where the SEC's authority ends and the CFTC's begins.
Let's start with the definition that changes everything: digital commodities.
Right. A digital commodity is defined as an asset intrinsically linked to a blockchain system. That means its value relates to the system's function, governance, network services, payments. The key assignment here is that the CFTC gets exclusive jurisdiction over the spot market for these assets, for anti-fraud, anti-manipulation.
That sets the stage. But what about assets that start as fundraisers, like an ICO?
Those are called investment contract assets. If they're sold initially to raise capital, they are temporarily treated as a security. They fall under the SEC's purview during that initial sale. Standard stuff.
But here's the critical pivot, the part that provides the clarity, right? The moment that investment contract asset is resold on a secondary market by anyone other than the issuer, it immediately converts. It becomes a digital commodity.
That conversion is the Clarity Act's main mechanism. It's the whole point. It instantly shifts oversight from the SEC's complex securities regime to the CFTC's commodities regime. For market operators, this solves a huge legal headache. They no longer have to worry about an asset being a security forever just because it was used for fundraising years ago.
And I noted a specific benefit for nationwide adoption in the bill. The Clarity Act explicitly exempts digital commodities from state blue sky laws. That streamlines compliance across all 50 states.
Yes, and crucially, the Act tries to protect core DeFi innovation itself. It carves out exemptions for certain activities, like validating transactions, providing UIs, developing wallets from most SEC or CFTC regulations.
So the legislative intent seems to be fostering innovation while keeping the anti-fraud guardrails in place. It's a pragmatic approach.
It is, and we should remember the political context. The Clarity Act, favored by the industry, faces competition from other proposals like the Senate's draft RFIA. That one leans more toward retaining SEC oversight. But these competing efforts, they all signal the same goal: establish a clear framework to position the U.S. as a crypto leader. And that's essential if platforms like Avantis are going to serve institutional demand.
So, zooming back out to Avantis, what does all this mean for the investment vehicle itself? Let's look at the AVNT token and the institutional support they've gathered.
The AVNT token has a fixed supply of 1 billion, and its utility is tightly woven into the protocol's health. Holders govern the platform, they vote on fees, asset listings, buybacks, but its most critical function is security.
The ultimate backstop.
Exactly. Staked AVNT tokens in the security module act as the protocol's self-insurance policy. If the USDC vault takes a massive catastrophic loss from an oracle failure or extreme volatility, the staked AVNT tokens are automatically liquidated to absorb that deficit. It's the final sacrificial layer, and in return, stakers get AVNT rewards and trading fee discounts.
That's a high-risk, high-reward mechanic. It aligns the token holder directly with the platform's stability, and it seems like they are heavily backed.
Absolutely. They raised $12 million from top-tier VCs. We're talking Pantera Capital, Founders Fund, Galaxy Digital, and the Base Ecosystem Fund. That shows significant institutional confidence. Plus, the big exchange listings, Binance, Coinbase in September 2025, that really speaks to their market traction.
Looking forward, their roadmap is incredibly ambitious. It goes well beyond just macro trading.
Yeah, they plan to expand their universal leverage layer into entirely new markets, like prediction markets and sports betting, using that same synthetic model. They're also focused on accessibility. They're developing a base mobile app with native integration aiming at non-crypto users, maybe even with Apple Pay for deposits.
But the big infrastructure move scheduled for 2026 is the real game changer, Avantis V2.
Yes, scheduled for H2 2026, Avantis V2 is envisioned as a dedicated Layer 2 solution built just for them. This upgrade aims for a huge leap in capital efficiency, more than 10x, and will introduce cross-margin trading. So you can collateralize your tokenized Apple stock perpetual with your ETH, for example. It really solidifies their position as a full-stack macro platform.
So we've covered Avantis' technological edge in creating the synthetic universal leverage layer for everything from crude oil to NVIDIA stock. And we've covered the crucial legislative attempt in the U.S. to define its regulatory home via the Clarity Act.
Avantis is building the foundation for the next generation of global leveraged finance. I mean, their success hinges not just on the tech, the 500x leverage, the zero fee model, but fundamentally on whether the political process, that battle between the CFTC and the SEC, can finally deliver the regulatory clarity needed for widespread institutional adoption. The tech is ready. The rules are still being written.
And the price volatility of the AVNT token just perfectly illustrates this tension. The token dropped 85% from its all-time high, despite consistent whale accumulation and very bullish technicals in late 2025. This shows the intense divide between that fundamental long-term infrastructure potential and the immediate high-risk, speculative nature of the decentralized derivatives market. Which force do you think will ultimately determine the future of RWA trading on-chain? Something for you to mull over until our next deep dive.